why you should consider using AI or artificial intelligence when investing. Now, coming from my background as a trader and a Forex investor, I learned that psychology is the name of the game. Trading itself or investing is actually pretty simple. It's a very logical process, but the psychology behind it is actually the hardest part. If you can't get your psychology in the right place, that leaves room for error. It can cause you to be less profitable, and it can actually make you lose money. And most people lose money when investing because their psychology is not prepared for that world. Now, psychological training and developing a mindset of an investor, that can take a long time. I know people who were able to become consistent and profitable investors and traders within maybe just a couple of months, but that's very rare. Most of the time, I see it take people at least a year or two until they're finally able to manage those emotions and enter into only the good investments, and more importantly, manage that investment well. So there are actually two opportunities for people to lose money if their psychology is wrong. On the front end of the investment, before they ever invest, number one, they could get their analysis wrong. Well, if you get too excited about an investment, you maybe start cutting corners in some places. You see an investment, you get really excited about it, and it doesn't quite meet all of your criteria, but you're so excited about the investment that you do it anyways. So that's one opportunity for an investor to lose money. Another opportunity is getting in too early. So maybe there's an opportunity for you to invest into something, but it would be a good opportunity to do it in a week or 2 weeks or maybe even a month or maybe even in a year. But you decide to pull the trigger now because you want to make sure that you don't miss it. The fear of missing out, that's all part of psychology. So that's on the front end. Another thing is getting a little bit too nervous at the beginning, waiting for the market to start moving. Like let's say you're buying gold bars or something. And so the price of gold bars is X amount. And you're like, you know what? I'm just going to wait for it to start going up before I buy it. And by the time you realize that it's going to go up, it's already moved a very large amount. And now you're basically investing based on FOMO, or fear of missing out. Those are two opportunities to lose money on the front end of an investment if your psychology is not in the right place. Now, if you train your psychology to not be emotional about your investments, those issues would not affect you. Now, on the back end of the investment, when we're managing an investment, let's say we bought gold at $1,700 an ounce and we believe that it's going to go to $2,000 an ounce. And so if we're buying gold at $1,700 an ounce and it gets up to $1,800 an ounce or $1,900 an ounce, and we're like, wow, you know what? Honestly, I know my target is at $2,000 an ounce and all the facts and the data point to $2,000 an ounce. I'm just going to start liquidating now. Sometimes traders or investors, they get nervous while managing that investment. And maybe it's because it took too long for price to move finally. Maybe it took too long for that investment to perform. And so they start making irrational decisions and they're no longer basing them on logic, but based on how they feel. So here's a quick example. Let's say, again, with gold, it's just such an easy instrument for this example. Let's say gold is $1,700 an ounce. We buy gold and then it bumps up to $1,900 an ounce overnight. And we're like, wow, we're the best investors ever. But you know what? We're very disciplined investors and we're going to wait until gold hits $2,000 an ounce. Right there, that's a good example of discipline and good psychology. But let's say after that spike up to 1900, we immediately crash back down to, let's say, 1600. So below where we started. So now we're at a loss. As investors, we might get a little bit nervous. We're like, hey, what's going on? I was making so much money there for a second, but now all of a sudden price crashed back down. And that move right there is a very, very common phenomenon that happens in the market. And so that's an issue for a lot of people and it causes them to be nervous. And now they're just praying that price is going to go back up to break even. So from 1600, maybe back up to 1700 where they bought. And so now they can at least get out of their trade or their investment at break even, right? Or maybe that whole process took 3 months or 4 months or a year or 5 years. And so now they're a little bit nervous. They're like, hey, I'm nervous. I don't know if price is going to continue going up. I'd rather just get out at break even. And when they get out at break even, what do you know? Price actually does end up going to 2,000 and maybe 20,000 eventually, right? Obviously, it's not something that would happen overnight, but it could technically happen. And that could have been the best investment of their life, but their psychology was wrong. And so they were not able to capitalize on that move because their head was not in the right place. They didn't have the right mindset. They didn't take care of their psychology. Now, all this to say, all these different things that can happen. That doesn't happen when you have AI. AI is very, very logical. So the reason that I believe that most investors should consider using some form of AI in their investing is because AI is emotionless. AI simply follows code. It has lines of code that's written and it just follows and executes what those lines of code say. Unlike a human, they're not worried about missing out. They're not worried about different fluctuations in the market. The robot or the AI simply executes on the lines of code that were given to it. And that really removes a lot of variability in our investing, because if we're investing and we're always doing small little changes on every single trade or investment, that can really ruin our track record, because if we're not following the same prediction and the same statistics on every single execution, that can really mess with our profitability factor. And most people think that they're making themselves more profitable by changing things up with every single investment. The math checks out if you have every single investment be very uniform and consistent and targeting the same profit targets and the same loss targets. AI can also be used to analyze investments. So maybe you don't want the AI to actually execute investments on your behalf, but you can have the AI do analysis for you. Now, there are certain AI softwares out there that will literally give you alerts and signals whenever a certain criteria happens. So for example, if we go back to that gold example, if you don't want to sit there in front of your computer and wait until gold reaches, let's say $1,600 or $1,500, so it dips down a little bit so that we can get an entry at a good price, you can use a software or an AI to tell you that. As soon as it happens, it alerts you. It sends an alert to your phone, to your email, wherever you want to receive an alert. The AI software can actually alert you and tell you what's going on so that you don't miss out on any moves like that. And I know a lot of investors who use software and AI for that reason. There are also some cons to using AI to invest. Now, there aren't many cons to using it. However, you do run the risk of running into some technical difficulties. So for example, if you're using AI to invest and then something crashes or there's a bug in the code or something happens that isn't supposed to happen, it's a lot harder to troubleshoot a software than it is if there's a human sitting there and manually making these trades or investments, because a software, again, it doesn't have any emotions. It can't infer certain information like a human can. So having a human sit there is obviously the best option, and that's traditionally how hedge funds and large institutions have done it. However, a lot of people are using AI to integrate with the human. So that way you have a human and you have an AI providing information to the human that the human can now use to execute in a more educated way. And so if that human is able to execute based on what the AI is telling him, they can really boost their profitability, because again, AI gives them very factual data, just an analysis or a prediction maybe based on math, on different algorithms, and then the human can execute based on that. And if that human has mastered their psychology, they'll be able to execute and manage the trade successfully or investment. They'll be able to hold the course of that entire investment and exit only when they meet their profit targets. And that's how they get their math so consistent. All right, guys, hopefully this makes sense on why you should be using AI to invest. I think it's a great tool. There's many different types of AI, and I actually use it personally in many of my investments. I use AI to make my investments more profitable, and I think you should too. I'll see you all in the next video.